Is a home equity line of credit still tax deductible? It's a new year and new laws. Let's get into it for today's episode. Hey everyone, I'm Clayton Morris, longtime real estate investor, and this channel is devoted to helping you achieve financial freedom, passive income, letting you get out of the 9-to-5 rat race, putting more time back in your life, and finding out what it is you want to do with your life and having that cash flow that's coming in every month from rental real estate. We talk about buy and hold real estate here on the channel. That's the way that I've achieved financial freedom. That's the way that hundreds of our clients have achieved financial freedom. And that's the way that you should achieve financial freedom. Now, you can do it in other ways. You can buy gold, I guess. I don't know how else you can do it, but if you figure out another way to do it, then by all means go ahead and do it. Our vehicle, though, is buy and hold real estate. And one of the advantages that we've had over the years is being able to utilize the tax code for our benefit. And as a real estate investor, if you're paying taxes, you're doing it wrong. Real estate investors pay almost nothing in taxes because the tax code is written to benefit real estate investors. Almost every member of Congress is a real estate investor. They own businesses, LLCs, pass-through entities that own real estate. It's the number one way to build wealth. And the tax code has all sorts of little caveats and nuggets in there to benefit you as a real estate investor. One of the things that it used to have was an interest deduction for home equity lines of credit. Now, what is a home equity line of credit? It's different than a home equity loan. A line of credit is simply that. It's a line. It's an open line for you to use to go out and purchase. You could buy a boat if you wanted to, or if you were smart, you'd go and buy a rental property. You'd buy a piece of land, you'd build a house on it, and you'd rent it out. That's a killer way of using a home equity line to build wealth. That interest used to be deductible when you would go out and purchase an investment. Now, with the new changes to the tax law, the short answer on this question, is a home equity line of credit still tax deductible? The short answer is yes, but in a very narrow way that does not necessarily benefit us as real estate investors. Here's how it's different. You used to be able to, taxpayers could deduct an interest on home equity loans of up to $100,000 in interest, $50,000 for couples who were filing separately. That has changed. That has now changed. Now, you have to only be able to use a home equity line of credit in order to improve your current property, improve the house that you live in. That changes things. Now you can still deduct a portion of that from your taxes, if you're using a home equity line of credit on a capital improvement to your primary residence. Dun, dun, dun. So what does that mean? That means I cannot take that home equity line of credit anymore, go out and purchase a separate entity, a separate $50,000 property, and pay interest on that and have that be written off. So let's say I've got 3.99% as my home equity line of credit, and I go out and purchase a $50,000 rental property. Oh well, that 3.99% interest that I'm now paying on the cash that I used to purchase that investment property is now no longer a tax write-off. Now, a number of experts have weighed in on this, and we're really going to need to get the IRS fully baked on how they see this. But all of the tax experts that I've spoken to and have read interviews with all say the same thing, that this is now shut down for writing off the interest if you're purchasing an investment separate from a capital improvement on your primary house. Now, look, I'm sure that there will be tax experts who will come up with a strategy and a way in which they can find some sort of a loophole to make this make sense. But I don't see it. I don't see it, because a business investment being purchased with a home equity line of credit is no longer a write-off for the interest write-off. You can't do it. So I don't know how you'd go around that, frankly, with the IRS code, the way that it's currently written. It wouldn't make sense. So bottom line, despite these rampant rumors, though, to the contrary, home equity-based lending is not going anywhere. And honestly, let's look at this for a second, okay? So if we have a home equity line of credit, it's still a killer strategy to go out and buy investment properties. Again, I've talked about this on past shows. I love this strategy because it's a line of credit. I can rinse and repeat all day long. If you have a primary mortgage and you have equity, why wouldn't you use that equity? The bank is giving you a line of credit. It's giving you leverage to go out and purchase and add to your net worth. Why wouldn't you use it? So what if the interest is now no longer a write-off? It's still 3.99% or maybe 4.25%, but guess what? If the rental property is cash flowing at 9% or even 8%, I'd take that all day long. One of my mentors, the great Robert Sheeman, who owns thousands of properties, and one of the things he taught me, if you go back and listen to my episodes on the podcast with Robert, on the Investing in Real Estate podcast, what he said is so true, that if he is paying 11% interest, but he's cash flowing 12%, why wouldn't he take that? He said, I'd still take that deal all day long. Well, guess what? If you're paying 4% on a home equity line of credit, but you're making 8% from a tenant living in your investment property, that's a 4% difference. Why wouldn't you take that money? Why wouldn't you take that as an opportunity to leverage a home equity line of credit? I certainly would. I'd certainly prefer using that over paying 12%. So again, a home equity line of credit, still a killer strategy for you to go out and purchase rental properties. Again, you're adding to your net worth. You then get to claim depreciation on that rental property that you now just purchased. The business purchases of that property are also a separate write-off that has nothing to do with the HELOC. So it's still a killer strategy. But yes, to answer the question, is a HELOC still tax deductible? It is, but very narrow window now, only if you're making capital improvements to your own property. So adding an addition to the house, putting in new carpeting, that type of thing, but not for going out and purchasing rental property. So anyway, I'd love to hear your thoughts. I know many of our clients at Morris Invest have used a home equity line of credit to purchase rental properties. To me, it's a killer way of doing it because you're increasing your net worth. You're able to start cash flowing. And guess what? The tenant is paying the home equity line of credit back. So it's a killer strategy. Anyway, I'd love to hear how you've used a home equity line of credit to increase your net worth. You can leave some comments in the thread below. And thanks as always for subscribing and sharing this show with those in your life that you think, you know what, need a little kick in the pants. You know people around you that need a little kick in the pants in order to start building wealth. And I hope that they find this show valuable. That's why we do it, and we do it multiple times a week, and we do it for free. So you can go out there, take action, become a real estate investor, and create financial intelligence in your community and in your house. We'll see you next time, everyone.